The mastery of market distribution is the singular skill separating professional traders from those perpetually caught in the final deadly bull traps. Distribution is not merely a price decline, but a highly organized campaign by institutional operators to offload their assets onto the unsuspecting public, while price action still appears robust. Richard Wyckoff dedicated his life to exposing these maneuvers, recognizing that understanding the top is far more crucial than chasing momentum. By isolating 5 non-negotiable stages, traders can preemptively identify professional selling pressure and position themselves for the inevitable markdown. The challenge of distribution lies in its deceptive nature, characterized by high volume and aggressive buying that masks the true intentions of the largest players. Retail participants, driven by euphoria and fear of missing out, become the necessary exit liquidity for those who accumulated at much lower prices. The promise of mastering these 5 Wyckoff steps is the ability to stand aside during the final frenzy, or even initiate short positions with high probability. This framework allows traders to shift their perspective from simply reacting to price movements to understanding the underlying supply and demand dynamics orchestrated by strong hands. Before diving into the critical first step of distribution, it is imperative to secure your position within this community of informed traders. Before we continue, please take a moment to subscribe and leave a quick comment, even just a single word. This simple action greatly helps the algorithm recommend this video to more people and shows that this kind of content truly matters and is worth creating. And please do not forget to return to the channel during challenging times when trading becomes difficult and your confidence starts to waver, as consistent learning is the key to longevity. The core definition of distribution centers on the calculated transfer of shares from informed institutional hands, referred to as strong hands, to uninformed retail investors, known as weak hands. This process must occur gradually to avoid crashing the market prematurely, which would prevent the large sellers from achieving optimal exit prices. They maintain the appearance of strength through aggressive buying on dips and highly publicized positive news, ensuring the public remains optimistic. The fundamental goal for the Wyckoff practitioner is to recognize this structural shift before the facade crumbles completely. Step 1 of mastering distribution focuses on identifying the initial halt of the uptrend and establishing the boundaries of the distribution range, known as Phase A. This phase marks the first significant clash between residual demand and emerging institutional supply. The initial events that define this phase are critical because they set the stage for all subsequent selling operations. Without a clearly defined range, analyzing the later phases becomes impossible and highly subjective. The very first warning sign is the appearance of Fission preliminary supply. This event manifests as significant volume appearing during an upward move, indicating that institutional selling has started for the first time. While the price might continue to rise, the increase in volume suggests that large blocks of shares are being absorbed by the market. This marks the moment when the uptrend begins to lose its previously unquestioned momentum, initiating the process of consolidation. It is the subtle tremor before the earthquake, visible only to those analyzing volume alongside price. Following the preliminary supply, the market usually experiences the buying climax. This is characterized by a final dramatic rush of buying, often occurring on massive climactic volume. This event exhausts the remaining strong demand from the public and marks the highest point, or the initial high, of the entire distribution range. It is often fueled by extreme optimism and represents the final capitulation of bears and the aggressive entry of late-stage bulls. The buying climax is the point where the institutions sell the largest single volume of shares, capitalizing on public excitement. Immediately succeeding the buying climax is the automatic reaction. This is an unavoidable and sharp drop in price that occurs because the massive supply introduced during the climax overwhelms any remaining demand. The automatic reaction establishes the lower boundary of the distribution range, creating the initial support level. The speed and depth of this reaction provide the first tangible proof that supply has temporarily gained control of the market momentum. This reaction is crucial because it defines the initial trading environment for Phase B. Finally, Phase A concludes with the secondary test effet of the buying climax area. The price returns to the vicinity of the previous high, but crucially, this return occurs on noticeably lower volume. The low volume confirms that the aggressive demand seen during the climax has been successfully absorbed by the large sellers. If the price fails to exceed the buying climax high, or does so only marginally, it confirms that supply remains heavy overhead. This test validates the upper resistance boundary of the newly formed distribution zone. The actionable insight derived from Step 1 is the precise definition of the distribution boundaries. The high of the buying climax and the low of the automatic reaction define the clear upper resistance and lower support of the initial distribution zone. These two levels form the box within which the institutional selling campaign will continue to operate during the next phase. Traders must delineate this range accurately, as these boundaries will serve as reference points for identifying false breakouts and critical breakdowns later on. Understanding these initial events provides the necessary map for navigating the complex distribution structure. Step 2, corresponding to Wyckoff's Phase B, is the longest and most critical period for systematic professional distribution. This phase is characterized by methodical selling, where institutional operators continuously offload their inventory while maintaining the price within the established trading boundaries. The primary goal of Phase B is the complete absorption of demand, a process that requires significant time and repeated testing of both the resistance and support levels. This back-and-forth movement builds the necessary energy for the subsequent markdown, which Wyckoff termed the cause. The characteristics of Phase B involve the price moving horizontally, testing both the resistance established by the buying climax and the support defined by the automatic reaction multiple times. These movements create minor swings within the range, but neither buyers nor sellers are able to achieve a sustained breakout. The professional operators utilize these swings to sell into strength and cover short positions near support, maximizing their average exit price. This churning action prevents the public from recognizing the underlying weakness of the structure. Key evidence of distribution during this phase is primarily found through detailed volume analysis. Observing rallies that fail to generate the same level of volume as previous upward moves is a major red flag. This declining volume on pushes higher indicates a lack of sustained interest and follow-through demand. Conversely, the selling waves or reactions often show increasing volume, suggesting that supply is becoming more dominant with each cycle. The comparison of volume between rallies and reactions is essential for diagnosing the health of the structure. Furthermore, Phase B involves multiple tests of supply. These are attempts by the remaining demand to push the price past the resistance established by the buying climax. Crucially, these attempts fail quickly, showing that heavy overhead supply is ready and waiting to cap the price. Each failed test reinforces the conviction that the institutions are actively defending the upper boundary of the range, systematically distributing their shares into the market's remaining strength. These failures signal that the market is saturated with supply at higher levels. The concept of cause is fundamental to understanding Phase B. Wyckoff emphasized that every significant price movement, or effect, must be preceded by a period of preparation, the cause. This entire lengthy phase of sideways movement is building the necessary energy, the accumulation of short positions and the completion of selling, for the eventual downtrend. The longer and wider the distribution range in Phase B, the greater the potential effect or markdown that is likely to follow. Therefore, patience in analyzing this phase is highly rewarded. During Phase B, traders must resist the temptation to trade the smaller swings aggressively, instead focusing on the overall structural integrity. The repetitive nature of the range-bound action lulls many traders into believing the market is simply consolidating before the next leg up. However, the subtle shifts in volume and the inability of rallies to sustain momentum indicate that the market is preparing for a significant reversal. This phase is the proving ground where the strong hands complete their selling operation. Step 3, corresponding to Wyckoff's Phase C, is the most critical and often the most deceptive phase of distribution, designed specifically to finalize institutional selling and trap late participants. This phase features the market's decisive movement above the established range, giving the illusion of a powerful breakout and the resumption of the bull market. Its primary purpose is to clear out all remaining stop orders placed just above the range resistance and entice a final wave of retail buying. This action ensures the large operators can sell their final inventory at maximum prices. The critical test that defines this phase is the E-way, upthrust or upthrust after distribution, UTAD. This event is a sharp, temporary penetration above the resistance levels established by the buying climax and the secondary tests in Phase A and B. It is a false breakout that appears extremely bullish, often accompanied by strong initial momentum that convinces traders the distribution range was merely a reaccumulation. The upthrust is the final, dramatic flourish used by the institutions to attract the last remaining pockets of demand. Interpreting the upthrust requires immediate attention to the price action following the penetration. The most crucial sign is the rapid failure to sustain. The move above the resistance price quickly falls back into the established trading range, often closing well below the resistance level, effectively signaling that the move was a massive trap. This failure confirms that the institutional supply waiting just above the range was overwhelming and absorbed all the buying pressure generated by the false breakout. The high volume associated with the upthrust quickly fades as the price drops back inside the range. The upthrust confirms two vital things for the Wyckoff practitioner. First, it confirms that the large operators have successfully completed their final selling operation into the last surge of public optimism. Second, it confirms that the market is decisively weak above the distribution range, meaning any attempt to rally higher will be met with immediate and heavy supply. This event is the final structural confirmation that the distribution process is complete and the market is ready for the markdown phase, recognizing the UTAD as a selling opportunity rather than a buying opportunity is the hallmark of advanced Wyckoff analysis. For traders who have patiently observed Phase A and B, the upthrust provides the highest probability confirmation of the impending reversal. It cleanses the market of remaining demand and provides a clear point of reference for setting protective stops. While Phase B built the cause, Phase C provides the definitive trigger, demonstrating that the market cannot sustain prices above the established resistance. The failure of the upthrust is the final, unambiguous signal that the market structure is now bearish. Step 4, corresponding to Wyckoff's Phase D, represents the decisive shift in control from demand to supply, providing the optimal entry signal for initiating short positions. After the upthrust has trapped late buyers and the distribution is complete, the market must demonstrate genuine weakness by breaking below the established support. This phase is characterized by the price action confirming that the path of least resistance is now definitively downward. The first critical event in this phase is the sign of weakness. This is a decisive break below the support established earlier by the automatic reaction and repeatedly tested during Phase B. This break confirms the dominance of supply as the price moves out of the bottom of the distribution range. It is often accompanied by high volume, indicating that genuine institutional participation is driving the decline, not just minor profit-taking. This event is the first undeniable evidence that the structure has reversed its character. The sign of weakness is the point of no return for the prevailing uptrend, as the market structure has been irrevocably broken. Following this breakdown, the subsequent price action often involves a swift continuation of the decline, confirming the bearish momentum. The high volume on the break suggests institutions are now actively pushing the market lower, no longer needing to mask their selling. This structural break validates the entire distribution pattern analyzed in the previous 3 steps. The market rarely moves straight down without offering a second chance, which brings us to the optimal entry zone, the last point of supply. After the initial sign of weakness, the price typically attempts a weak, short-lived rally back toward the broken support level. This rally tests the newly broken support, which now acts as resistance, confirming the structural change. The inability of the price to rally back into the distribution range confirms the market's weakness. This retest, the last point of supply, provides the highest probability short entry point. Traders can enter a short position as the price fails at this newly established resistance, confident that the market has confirmed its bearish posture. Entering at the last point of supply allows for a tight protective stop loss placed just above the resistance, offering an excellent risk-to-reward ratio for the impending markdown. This is the professional entry, waiting for confirmation rather than chasing the initial breakdown. The failure of the market to sustain any rally during Phase D is crucial evidence. Even small movements upward are met with supply that quickly pushes the price lower. This price behavior contrasts sharply with the strong rallies seen during the uptrend and confirms that demand has been exhausted. The sign of weakness and the subsequent last point of supply provide the clear sequence necessary for successful trading execution. Step 5, corresponding to Wyckoff's Phase E, is the payoff phase where the market leaves the distribution range and enters a sustained downtrend or markdown. This phase is the effect resulting from the cause built during the lengthy distribution process. The structure of the market has definitively shifted, and supply remains firmly in control until the next accumulation phase begins. In Phase E, price action is dominated by downward surges, often punctuated by periods of panic selling and fear. The weak, short-lived rallies that occur are quickly overwhelmed by renewed selling pressure, confirming the market's deeply bearish character. The public, having bought heavily during the upthrust and the initial breakdown, now starts liquidating their positions, adding fuel to the decline. This sustained markdown is the culmination of the institutional selling campaign. Practical application requires robust trade management once the short position is established at the last point of supply. One of Wyckoff's most powerful tools for managing the trade is target setting. Using the point and figure methodology. By calculating the horizontal count derived from the width of the distribution range, steps 1 and 2, traders can project potential minimum price targets for the markdown. This provides an objective basis for setting profit objectives rather than relying on arbitrary levels. The point and figure count translates the energy built during Phase B, the cause, into a quantifiable distance, the effect. This method ensures that profit targets are fundamentally aligned with the structural dynamics of the market. Utilizing this technique gives the trader a powerful edge, allowing them to patiently hold the short position through the volatility of the markdown phase. It transforms the distribution analysis into a complete trade plan. For effective trade management, the high of the last point of supply serves as the protective stop loss. If the market manages to rally back above this point, it invalidates the entire bearish structure, suggesting the distribution was perhaps a failed pattern or a reaccumulation. Keeping the stop tight and defined by the structure is essential for capital preservation, adhering to the principle that the market should not return to the area of the final supply. A disciplined stop ensures that losses are minimal if the analysis proves incorrect. Understanding Phase E confirms that the market structure has definitively shifted from accumulation and markup to distribution and markdown. The trader should expect volatility, sharp drops, and minimal bullish follow-through until the market reaches a level where institutional buying interest reappears. The successful execution of a distribution trade relies entirely on the precise identification and confirmation of the preceding 4 steps. The 5 steps, establishing the range, systematic absorption, executing the final trap, confirming the breakdown, and managing the markdown, form an unbreakable sequence derived from the principles of Richard Wyckoff. To master distribution is to master the art of reading the true intentions of the professional operators. It demands patience during the sideways action of Phase B and decisive action upon the confirmation of the upthrust and the sign of weakness. This comprehensive approach allows traders to avoid the devastating losses incurred when buying into the final stages of a bull market. By focusing on volume, structural breaks, and the relationship between cause and effect, the Wyckoff method provides a clear map for navigating the complex terrain of market tops. The ability to recognize these patterns transforms a reactive trader into a proactive analyst, capable of anticipating major reversals. For those who wish to delve deeper into the methodologies that underpin this distribution analysis and gain a complete understanding of the market cycles Wyckoff identified, further study is essential. Richard Wyckoff's original work provides unparalleled insights into the minds of the large operators and the mechanical processes of the market. Applying his time-tested strategies requires grounding in his foundational texts. If you are committed to elevating your trading from speculation to a systematic professional endeavor, consider exploring the adapted edition of Richard Wyckoff's classic work, How I Trade and Invest in Stocks and Bonds. This essential text breaks down his proven methods for analyzing market structure, determining the intentions of major players, and making informed, high-probability trading decisions based on supply and demand. It offers the full context necessary to apply these 5 steps consistently across any market and any time frame, building confidence in your ability to read the tape like a professional. You can find the link to this foundational resource in the description below, taking the next step toward mastering Wyckoff's powerful market philosophy.